Hello, I'm Lindsay Hall, Chief Market Strategist for the RMB Group. Welcome to our video series, a short course in futures and options. In this lesson, we will help you understand the power of using options for trades similar to the crude oil futures contract trade we discussed towards the beginning of the series. Remember our crude oil example from the beginning of the series? To illustrate the power of options, let's use it again, only this time offering an option alternative. Since the actual cash purchase of crude oil is out of reach for most investors, we will ignore it. For the sake of comparison, we're going to assume that the price of a well-rounded energy portfolio will rise and fall percentage-wise with crude oil. This is not necessarily a correct assumption, as any energy stock investor will tell you. Many energy stocks have not kept pace with crude. It is, however, useful as a benchmark to illustrate the leverage of futures and options. As we mentioned earlier, the price of an energy stock is affected by more than the price of oil. Refinery operations, overhead, management, and the general direction of the stock market all have an effect. On the other hand, our option, like the futures contract in the earlier example, is a pure play on the price of crude. This works the same for other commodities as well. For example, Archer Daniels Midland, ADM is the symbol, is a very large grain processor, but during a drought, odds are you'd be better off buying the grain itself. Why? Because when you buy ADM, you're buying ADM's management and corporate structure. When you buy grain call options, the underlying instrument is the grain itself. Assume that instead of buying crude oil in the spot market, investing in an energy-based mutual fund, or buying a futures contract, we decide to buy a December option traded on the New York Mercantile Exchange, or the NYMEX. Why buy a call option? Because unlike a futures contract, our risk is fixed to the amount we pay for it. It is also a fraction of the amount we would have to spend to buy an equivalent dollar amount of energy stocks or mutual funds. Better still, we can take the money we would have spent on oil stocks or an energy-targeted mutual fund and invest it in super safe T-bills. Let's use an actual example as a learning tool. Prices will have changed by the time you view this, but you can use the same math to figure out potential risk and reward in other scenarios. At the time of this data, front-month crude oil futures are going for roughly $70 per barrel. We can buy $70 oil calls for approximately $5. To figure how much we pay for this option, we multiply the contract size of 1,000 barrels times the option cost of $5 to get $5,000. By paying this premium for opportunity insurance, we now own the right, but not the obligation, to be long a 1,000-barrel crude oil contract at a price of $70 per barrel from now until option expiration. The key phrase is, but not the obligation. Should crude fail to rally above $70 per barrel prior to the expiration of our option, we would simply not exercise our right to be long. We would forfeit the $5,000 plus any commission and fees we spent for our call, but no more. Since our risk is defined, we do not have to worry as much about day-to-day fluctuations or margin calls. This chart, crude oil monthly, the power of leverage, shows the earning potential of this call option. Since our option gives us the right to be long crude at a price of $70, a rally of $10 per barrel to $80 per barrel in the underlying futures contract would make each of our calls worth $10,000. Why? Because we could simply exercise our right to be long at $70 per barrel, then turn right around and sell for the going rate of $80 per barrel. $10 per barrel times the 1,000 barrel contract size equals $10,000. Using the same math, a rally to $90 per barrel would make each of our $70 call options worth at least $20,000 each. Tack on $1,000 for each dollar per barrel rise above this level. The fact we can exercise our options means that most of the time we won't have to. The price movement on the underlying instrument will be reflected in the price of the option itself. If we wanted to exit, we could simply sell the option. Compare this to the purchase of an energy stock like Chevron, CVX. At its current value, roughly of $74,520, one contract of December crude oil would buy 1,053 shares of CVX, given the current price of $70.75 per share. Gains in oil majors, like Chevron, nearly always lag gains in crude oil, but for the sake of argument, let's say they move 1-to-1. A rally from $70 per barrel to $80 per barrel in crude oil is a rise of roughly 14.2%. A corresponding 14.2% rally in CVX would make its price $80.80 per share. The gain on 1,053 shares would be the $10.05 per share gain times 1,053 shares, or $10,582.65. Not bad, right? At $80 per barrel, our $70 call option would be worth at least $10,000. Subtract the $5,000 we spent for our option for a net gain of $5,000. In the case of CVX, it took an investment of $74,520 to make $10,023.20. In the case of our crude call, it took an investment of only $5,000 to make $5,000. We didn't make as much as the stockholder, but the key is we had only $5,000 at risk. Better still, we could have taken the difference between the $5,000 we paid for our call and the $74,520 we would have paid for crude oil or an equivalent stock position and invested it elsewhere, earning interest, further lowering the net cost of our call option. When you look at the return on the actual investment, the option proves its point. So what's the downside? If crude oil doesn't rally, a stockholder still owns his or her stock. Whether or not this is a good thing depends on its performance. Our call, on the other hand, will expire with no value, leaving us $5,000 poorer. However, we didn't tie up $74,520 either. The $69,520 difference was busy earning us interest somewhere else. The same type of strategy can be applied to other commodities like gold, silver, copper, and soybeans. You can use it to gain important diversification in T-bonds, foreign currencies, and virtually every other optionable investment vehicle. As a side note, you may wish to see the listing of major U.S. contracts available in the accompanying PDF report on our website. Imagine the type of diversification you can achieve with a relatively small capital outlay. You can use options to create your own stock, bond, or foreign currency mutual fund. Why buy a portfolio when you can lease it? Take advantage of natural resource plays without a corporate intermediary. Create your own gold and or silver funds without the capital commitment required for an equivalent dollar value of stocks or bullion. Use as opportunity insurance and not miss surprise moves in the stock market, bonds, or virtually any other investment, or use as actual insurance to protect your holdings in the same. Generate income in slow markets, and much, much more. Why doesn't everyone do this? Many investors only look at the cost of the option itself rather than the big picture. They forget that the whole purpose of conservative option investing is to use options not as trading vehicles, but as substitutes for riskier, more capital-intensive alternatives. Consequently, they tend to overtrade. Now you know how to recognize the power of options in a portfolio and how they can work to help you limit your capital exposure. You have now finished our 7th video in this series. Our next video, Getting Option Quotes, will help guide you to some of the best places to find current market quotes for the options you seek.